All right, so in this video, I'm gonna show y'all how to set up your trading account for options trading, stock options. Okay. So when it comes to trading stock options, there's different platforms you can use. You can use Robinhood. You can use what's another one people be using? Webull. You can use the one I personally use, which is ThinkorSwim. I prefer the ThinkorSwim platform because you can move a lot of money in a fast amount of time. You know what I'm saying? It's not hard to get into trades. It's not hard to get out of trades. They execute very quickly. I prefer ThinkorSwim. A lot of millionaires and big money players, they use ThinkorSwim because of that same purpose. If you want to use the same platform I'm using, I'm going to show you how to set up a ThinkorSwim platform and not the other ones. So when setting up ThinkorSwim, you have to go through Charles Schwab first. So go to Google, type in Charles Schwab, boom. Open it up, and then open an account right here. Top right, create you an account. Once you create an account, you can make an individual account so you can have it personally under you. They're gonna require you to use a social security number. I'm about to move all of my trading accounts under my private trust. Eventually, once I do that, I'll make a video with how you can do that for yourself if you have a private trust and if you want to set it up like that. I'll do some type of video down the road like that. I won't go into detail. You would have to get the information from the private citizenship section inside the Liberation. But go ahead and go to Charles Schwab, open you an account up, create an individual account starting out unless you already know what you're doing. If you want to, you can set it all up by yourself on your phone or on your laptop. Or if you want to make it easy for yourself, I prefer you probably just give them a phone call, call Charles Schwab, and ask them to open you an individual options trading account. And when they do that for you, what's going to happen is that they'll open up the account. And if you go here to profile, whether it's on your phone or whether it's on the laptop, go to profile, go to margin and options if you're doing it by yourself. And when you go to margin and options, what you'll see is this right here. First thing it'll say is a margin line of credit. I believe when I first opened mine up, this was already checked. Like it had a green check or something like that next to it showing me that I had margin access. You do not want margin access when you trade in options. You only want to have cash accounts, okay? I'm not going to get into the full scope of that, but you do not want margin access. So if you're on the phone, tell them, hey, I only want a cash account. I don't want margin access. They'll make sure that you don't have margin access. If you're doing it yourself, make sure you get rid of the margin access. And if you don't know how to, call them on the phone and they'll do it for you. And then when you scroll down, you're going to see these right here. There's different levels that you can choose from when it comes to trading options. You do not want it to stay on this one here that says limited risk. You don't want it to stay on that one. The one that you want is the one that says moderate risk. It's called long. If you're on the phone, tell them that you want the long moderate risk option, or level 2 in other words. If you're on like doing it yourself, self-service type, then go ahead and choose this one down here at the bottom. You see how at the bottom it says apply for spreads, apply for short uncovered. You're going to see it right here when you first open the account up. You're going to click where it says apply for long, okay? And when you do that, it'll take like a day or two, maybe even a little bit less, you know what I'm saying? But they'll go ahead and approve it for you. And then once this gets approved, as you can see, I have a green check on mine. Then you're officially clear to trade stock options the way that we're going to trade stock options when it comes to making this money on, right? Once you do that and that's set up, you're going to have access now to the ThinkorSwim platform. This is what the ThinkorSwim platform looks like on this is what it looks like on my laptop. All right, it looks a little bit different on the phone. Let me see if I can like make this look a little easier for y'all to see. Hold up. Let me try to move this for y'all so y'all can see a little bit more. All right, there we go. Boom. And then let me move this out the way so I'm not in y'all face. Hold up. There we go. All right, cool. So this is what the ThinkorSwim platform looks like. So with ThinkorSwim on the platform, it looks the same on the phone, but the phone just look a little bit more streamlined. It doesn't look so wide as the computer screen, obviously, but it all works the same. So with the ThinkorSwim platform, this is how it works. You have right here in the top left, it says live trading and it says paper money. I clicked on paper money just now, right? What is this? I have to accept all of the disclosures. Oh, okay, there we go. So I clicked on the paper money side, right? Paper money is another way of saying a demo account. Now, on this paper money account, I do believe it is margin access, but it's still good for practice. And then if I go back to the live account, then you have the live account, right? So let me take it from this one, go back to the account I don't use. All right. So that's how you go back and forth between that. You have an eyeball right here next to account summary. If you don't want nobody to be able to see how much money you actually got going on in your account, you just tap this and it'll put asterisks above it, right? Over here as well too, so nobody can actually see what the dollar amount is in case you want privacy. It's up to you. And then if you look over here, this will show you how much cash you have on hand. Obviously, I don't use this account, so there's nothing in here. And then if we go to where it says trade over here on the far left, you click on trade, and then this middle section opens up. All right. Now, when you open this up, let me show y'all how to do this. Hold up. Go to the search bar. We'll type in whatever, contract or company we're looking for. Let's say I'm looking at PayPal, which I actually am looking at PayPal. PYPL. Right? Boom. It's the first one that pops up. PayPal Holdings. You click on it. All right. You see sell to the left. You see buy. All right. Anytime you're about to get into a trade, when it comes to options, you're going to always press the buy button, but before you do it, you have to pick a contract, okay? Now, the way we pick contracts is going to be on something called an options chain. Now, what I mean when I say options chain, I'm about to show you. All right, if you look, follow my mouse right here in the middle where it says options chain, boom, if I open it up like that, you're going to see all these different dates right here. These are dates. And on these dates, they represent expirations, because when you buy a options contract, that means that at some point in time, the value of it is going to expire. All right. Usually I only choose expiration dates that follow that same exact week, no more than like a week out. You know what I'm saying? It just depends on how long I think something's going to take for it to actually play out. In this case, the first one that you see at the top here says August 29th. That means that tomorrow, since today's the 28th, that all of these contracts will expire and become worthless. So if you are caught holding a trade and it's for this expiration date, which is the 29th, and the market closes and you did not sell it or liquidate it yet, then all the money you had inside of it, you're not going to get any of it. You're going to literally lose all of it because it becomes worthless. Okay. So you want to always make sure you sell your contracts, whatever they may be, whether you're in profit or whether you're in loss. You want to make sure you sell them before the expiration date so you don't lose everything that's inside of it. All right. So that's the purpose of expiration dates. If I chose to get into a trade tomorrow when the market opens, I wouldn't probably choose, this same one, since the expiration is so close. I would probably choose next week, which is September 5th. That means I can hold it all the way to next Friday, and I would expect for the trade to either play out in my favor beforehand so I can make my money and get out beforehand, or I would hold my trade until, whenever, and then make sure I sell it and liquidate my position before the market closes that day. Okay, so that's what an options chain is based on expiration dates. Now, to understand what these numbers are, and the easiest way I can explain these numbers, all right, I'm gonna break it down in different sections. The first thing I'm gonna break down is this middle section here. This word that says strike right here, strike. Strike price is the current. How do I explain this? Let me turn this down real quick. Hold up. Oh, it's like a music party in here. Oh, my arms are so dead from working out earlier. Okay, so strike prices. Now, strike prices are gonna be what determine how much money you can make in a certain sense. So what I mean is these strike prices, I want you to think of it like playing basketball. All right. If I'm going in for a call option, which is on the left here, all right, that means that I think the value of PayPal, since this is the one that I'm on, I think that the value, which is $70, is going to increase. All right. And in this case, if I'm choosing a call option that's on the left side of the strike prices, so over here, it's on this side, and the higher the value, it goes down. So you can see here, 70, 71, 2, 3, 4, 5, 6. It goes down. Puts means I think that the value of PayPal, which is $70, is going to decrease, which is on the right side over here, and that means that it goes up. So 70, 69, 68, 67, 66, 65, right? That's how that works. I don't know what I just did. Hold up. There we go. Okay. So back to explaining the strike prices. So with strike prices, it's like playing basketball. Okay. So let's say I think that PayPal is going to go up in value. I think that it's going to increase past $70. So if it's currently at $70, which is what this one is right here, you see how this is highlighted? Like this looks white, like the background looks a little bit bright. It looks kind of grayish basically. And then over here, these ones look black in the background. The ones that are highlighted in gray mean that they are currently called in the money. That's a terminology term that we use when it comes to trading options. This is called in the money. In the money means that these are already in profit, because the person down here at the $65 strike, they got in at $65 and they're still currently holding right now. They're $5, deep in the value increase of PayPal, and they're holding these contracts here, which currently they're up, I believe, $530 per contract. I don't know how many they're holding, but they're up $530 per contract. So they're already in profit. $70, this one is also in the money because it's currently $70.06. It's not $70 flat like how this is. Now, the first strike price past whatever the current price is, in this case it would be 71 if I'm looking for call options specifically. Then this one, the first one only, is called at the money. At the money means that it's extremely close to whatever the current value is. And then every strike price after the strike price that's considered at the money is called out of the money. All right. Now, as I was saying earlier with the basketball scenario, the way that you figure out what strike price you want to use is going to be based on where you think price is going to go based on technical analysis. When we was talking about the charts earlier, based on how you see the chart set up is going to determine where you think it's going to go. So, for example, think of in the money strike prices like the ones I'm highlighting. This is like a free throw, okay? In the basketball game, a free throw is the easiest shot you can take. This is the easiest ones you can get into. They're more secure and more safe because they're already in profit. You don't have to worry about, you know what I'm saying, if this is going to give you some money or not, right? Let's say if you bought the 69 strike price right here, right, and you think it's going to go up, it's already in profit. You would pay, what, $178 to get one contract. But every 1 cent that it moves up, right, is going to give you some type of profit on it, which would be, I think it's like currently $67 for every increment that it moves. So you would for sure get some money off of it, but it wouldn't be an extravagant amount of money. It would be a little something. It's like a free throw. You only get 1 point, but you get something. Now, when you do at the money, which is this 71 here, how it's not in profit yet, but it's close. It's the next one out of it, at the money. This one is like a layup. It's an easier shot to make than the ones that's down here. And you'll make a little bit more money than you would if it's in the money. You know what I'm saying? It's only, you know what I'm saying? It's not a free throw, but it's a layup. You'll get some more money, you know what I'm saying? Nothing too crazy. But I've made some good money before off of at the money plays. But then you have the big dogs right here, which is these ones that's past that. These are called out the money. Now, out the money is like shooting 3-pointers. All right. These are cheaper to get into because they're farther away than the current price. And to most people, and the platform, they don't think it's that likely for it to hit these prices. So what that means is that if you shoot from the 3-pointer and you choose these, and the price goes in your favor and it crosses the 72, 73, 74, 75, whatever the strike is, if it crosses these and it moves past it in a very good manner, this is going to pay you way more money than at the money or in the money. This is where you get the big bucks right here. This shit will pay you some crazy money if it goes into your favor, right? Typically, if I'm going to choose anything that's out of the money, I'm only going to go like no more than 3 or 4 past the one that's at the money. So if 71 is considered at the money, I would only look at 72, 73, 74, no more than 75 as a strike price, just depending on what the market is looking like, right? And it's the same thing with puts. It's just the opposite way. Puts are on the right side, right? And if you're expecting for price to go down, it works the exact same way. It's just going down. So if I'm looking at the current price being 70, right? 70 in this case is at the money because this is $70.06. This is $70 flat. So this one's not in profit yet. And then obviously these ones here are considered out of the money. That's how strike prices work. Okay. Hopefully that makes a little bit of sense. Rewatch this video as many times as you need to give you some more clarity to think about it. But always think about strike prices like the basketball scenario. It's the easiest way that helped me to understand and remember it myself, right? Now, what is the bid and the ask price? Okay. The bid and the ask price, I discussed this with y'all already at the very beginning. So I don't really have to go into it too much, but I'm going to show you how to calculate it, though. That's what I'm going to show you. I'm going to show you how to know what these numbers mean. So let's say I'm trying to get into let's say I'm trying to get into a put option, right? So let's say I think that PayPal is going to go down, which I actually think at the time you're making this video that PayPal is actually going to drop down pretty significant. I have a position at 69, 68, and 67, right? But let's just say, for example, we're going with the 70 strike price. The person who is selling this contract for people to buy, people like me and you that are trying to buy and get in and make some money off of it, this person wants 1.01 for the contract. That means he wants $101. This is 101 because every number you see is multiplied times 100 when it comes to trading options. Everything is multiplied by 100. So when you see 0.98, that's $98. 1.01 is 101. 0.33 right here is $33. This is $35. This one right here is $6. This one is $8. This, you know what I'm saying? Everything's times 100. Okay. So every one contract that you get, you're going to pay this amount plus whatever the commission is that the platform charges, which is usually like maybe like $1 or $2. Sometimes less than that, like a few cents. You know what I'm saying? So that's how you understand what these numbers are. And this is how you work the platform. So let's say if I want to get into a put option for PayPal, and I'm going to take a $70 strike. Okay. I'm going to click the ask price, not the bid price. You don't want to ever click the bid price. Click the ask price. This is what the seller wants. You click the ask price and you have a few options. Number one, always remember, you do not press sell when you're trying to get into this trade, whether you think it's going to go down or you think it's going to go up. You want to always press buy, whether you're trying to do a put option or whether you're trying to do a call option. You're going to buy a call option or you're going to buy a put option. Always remember that. Never press sell. Next to it, this is the contract amount right here. Currently, it automatically defaults to 10. I think there's a way to change it. I don't remember how. But anyways, you can manually come in here and change it. So if I just want one contract, I'm going to type in 1. All right. My expiration date is already where I had clicked for it to be, which is September 5th. This is my strike price right here. I have it as a put option. I can change it to call option if I wanted to, but I'm going to keep it at put. This is where I wanted it. And now I have the option here at the bottom to either do a market execution order, like I explained in the other video, between market execution, limit orders, and stop orders. I can do a limit order or I can do a stop order. Okay. It's going to be based on whatever the situation is. Go back and rewatch that video so you know the difference between everything and when you would use each one. But let's just say I want to do a market order. Always keep it at day. This right here where it says day, do not change it to GTC. Keep it at day always. All right. And then what you would do if you wanted to buy it, you press review. You'll see it here. Review what you're finna do. You buy one contract of PayPal 100, which this right here means PayPal, you know, whatever the price is times 100. This is the expiration date. A 70 strike price. This is a put, and MKT means market. It's literally everything I'm trying to do. All right. So the cost, since I'm doing a market execution, tends to be cheaper than if you do limits. So they wanted $101 for the asking price, but when I press market execution, you tend to get it at a small little discount. So I ended up, I'm gonna end up paying $99.50 for the contract. I paid 65 cents plus a penny, so 66 cents for the commissions for the platform. So all in all, it will cost me $100.16 as opposed to paying $101 for the contract. So it gave me a little small deal, right? If I wanted to go ahead and secure this, I would press send. It would send the request out into the platform, and then once the order gets filled, I'll get a notification in front of me saying order was filled, and then I'm into the trade. And when you want to get out of the trade, you go to your positions, right, wherever they may be. I think your position would be on this side, yeah, all account position right here, right? I'm not in a trade on this one, but you go to your positions, you would actually click on whatever position you're in, and then you would press the sell. That's when you would press the sell button. You would press the sell button, and you could sell it at market execution price, or you can sell it with a limit order or a limit stop, or a stop order. It's completely up to you. I tend to use market execution more than anything. I have not actually used limit or stop orders when it comes to trading options. I've used it for futures, but not for options trading. So it's going to be based on whatever it is you're trying to do personally for yourself. So this is how you use the ThinkorSwim platform. All right. This is how the computer looks. Your phone looks a little bit more streamlined, probably a little easier for you to see on your eyes. You know what I'm saying? But I recommend that you go through the platform. If you need some extra help, go to YouTube and find some videos. But this is a very, very good platform for you to use. If you want a more beginner-friendly platform, you can go to Robinhood. Robinhood is a good one for beginners. You know, it has good aesthetics and stuff like that for people. Very good platform for you to use. I just prefer to use ThinkorSwim, but use whatever works best for you. Okay. I'm trying to make sure that's everything so I didn't forget to show y'all something. Let me see. They even have a chart option on here, which you don't really need this chart option because we use TradingView. And then, yeah. So that's everything on there. And then once again, if you wanted to create a watch list for yourself, as you can see, since I went to PayPal and it popped up right here, if I want to add this to my watch list, you see right here, there's an option that says add to watch list. You just click it like this. And if I want to put it in the watch list I have currently, I can do that, or I can just create a new watch list, type the name of whatever I want it to be, and then save it. It's completely up to you. All right.